Over to you, Simon.
Thanks, and Paul. Evening, ladies and gents. Paul's wrong. You can't open in the next hour because for the next hour I talk. And it is a JSE Power Hour, so I will stick to my 1 hour time limit. I'm not going to carry on going until about 8 o'clock. I've left a lot of time for questions because I've got my 5 cents worth, and I will throw that out there. But I appreciate it's going to be a ton of questions. Individuals are going to have their own little nuances and the like. So a lot of time for questions at the end. So probably I'm about 45 minutes of talking. Then we'll take 15 or 20 minutes at the end of the presentation. Legal stuff, so that's my smiley face. So what are you looking at? Tax-free savings account. Announced by Minister Nene in his budget speech of February, so about a month ago, just up the road from us. He announces the tax-free savings accounts, effective 1 March 2015, so they are active, they are happening already, and up and running. I'm going to go into bunches of details, but the high level of them, individuals only, no companies, no trusts, no nothing. Individual people only can open a tax-free savings account, and we can touch in a moment around minors and infants and the like, but this is aimed at individuals. We can't do any other products in that sense, and it is tax-free. There is no catch. There's no small print that says tax-free unless it's a Thursday or something like that. This is a tax-free product through and through. And what do we mean by tax-free? No dividend withholding tax. So if you own a share or any listed product at the moment, a dividend is paid and a R1 dividend is declared, you receive 85 cents, 15 cents didn't even go into your bank account, it went straight to National Treasury. In this product, you get the full R1. So there's no dividend withholding tax, that 15% goes straight to you. There's no capital gains tax. If you sell a share and you have a capital gain, you're liable for 1/3 of your marginal tax rate. Upper bracket is 41%, so 1/3 of that, about 13.8%, more or less, give or take a tenth, no capital gain. So if you realize a profit within the tax-free savings account and sell it there and sell, there's no capital gains tax applicable on that at all. There's also no income tax. So at the moment, if you buy an equity or derivative and you buy it and sell it within a 3-year window, SARS might turn around and say, whoop, that was for income, we're going to charge you at your marginal tax rate, which is 3 times what capital gains is, no income. So there is no dividend withholding, no capital gain, no income tax, no tax on interest. So if you've got cash in the account, you earn interest, that is not applicable. Now, of course, at the moment, the way the legislation is put out, the first, and I can't remember the number now, about 26,000 of interest per year is tax-free. That is still applicable, still in place. What I think will happen is over the years that go through, SARS will probably not increase that 20-odd thousand that you can have interest tax-free. Or if they do increase it, they will increase it at a relatively slow rate, probably under inflation. I think they're going to broadly say, you want tax-free interest? Go get a tax-free savings account. So no tax on the interest received, no security transfer tax. When you do a purchase of a security, a share or something, you pay 0.25%. That goes to National Treasury. Again, no STT. So literally zero tax. Real McCoy, no catch. Well, one catch, estate duty. When you die, it goes into your estate and forms part of your estate and is liable for estate duty. I have a simple view on that. I'm dead. I got bigger problems. When I'm dead, you can tax me till the cows come home. That's fine. That's no sweat at all. So as long as you are living, that is the catch. If you are alive, there is no tax in this account. There are a bunch of rules in order for you to get the dispensation, in a sense, from the Revenue Service. But it is literally the only way you're going to get taxed on this is draw the money out or death. That's it. If it stays in there, it is tax-free. So it really is completely, absolutely tax-free. Some buts. It has to be in a tax-free savings account, TFSA. It has to be sitting within a TFSA. You cannot nominate after the event and say, and have an account here and an account there and say, oh, this is my tax-free. You have to open a dedicated tax-free savings account that the provider has said, this is a TFSA. Because they've got to then, when they report the CGTs and the like within that, and when dividends are paid, etc., they've got to be able to flag it as a tax-free savings account. So it's got to be done within a TFSA. And I'll come back in a second to who those providers are, where you will find them, and then we can drill a whole bunch of questions and Q&A around that as well. and specified products. You can't put just anything into a tax-free savings account. There is a list as drawn up by Revenue Service, and they say these are the only things that you can put in there. So you cannot take your holiday home from Hermanus or your red Ferrari or anything like that, or your stamp collection or wine collection or your equities or anything else. And I'll go through the list in a moment of what is allowed and isn't allowed. But it has to be products that are allowed to be within a tax-free savings account. And must be within limits. And what I mean by limits, and I'll come back to these as well, but quickly up front, there are limits as to how much we can transfer into a TFSA. Those limits are 30,000 Rand per individual per tax year. 30,000 a year, and 500,000 Rand over a lifetime of a tax individual. So you can put in 30,000 a year, and when you hit the 500,000 contributions, that's it. You cannot add to it any further. That 500,000 at current rates is going to take you about 16 years and 8 months of doing it at the full 30,000 per year. And it's not that you have to put in 30. You can put in 2,500 a month. That takes you to your 30. You can put in 10,000, and then next year put in. But if you put in 10,000 this year, your limit next year is 30,000. You don't say, well, I did 10 this year, so I'm going to roll that 20 over. You can do 30, and it's per tax year. So 1 March to 28 or 29 February, depending whether we're leaping or not. So there's always going to be that process where it's going to be per year. Again, I imagine that over time, Minister Nene and the ministers who will follow him in their annual budget speech will raise both of those two limits. Raise the 30,000 per year and raise the 500,000 for the lifetime contribution. What is important is that not roll over. What is equally important is do not exceed the limit. When I first heard about the tax-free savings account and the limits, I'm like, well, okay, so why didn't I just put 500,000 in and 30,000 a year will become liable for the tax? No. If you exceed the 30,000 a year limit, you will be penalized, and the penalty will be that you will be taxed on that excess at your marginal tax rate, max 41%. And the onus is on you as the individual, as the investor, to make sure you don't exceed the limit. It is not up to the provider, it is not up to SARS, it is up to you, the individual, to make sure you don't exceed the limit. An important point, if I put 30,000 in today and I go and buy DBXWD and it goes to 31,000, that's not an exceeding the limit, that's a capital growth. So it's the amount that you can physically move in, and it is on your onus to make sure that you don't exceed it. It's not complicated, but make sure if you're running an Excel spreadsheet, you know what you're doing with it, and that the right amounts are going in every period forward. As I say, 500,000 lifetime limit, so at current levels, it'll take us almost 17 years to get to that full limit, and as I say, will likely be adjusted over time, and that in the budget speeches every year, we would expect increases of both the 30,000 and the 500,000. And again, they won't be retroactive. It will be, well, from this March, instead of 30, you can do 32 or whatever the case may be. So I suspect that by the time we get to 17 years, we're probably going to have been able to put in 800,000, maybe even R1 million, because of those increases in the two respective limits. Critical, cash only. You can only deposit cash into a tax-free savings account. You cannot take an existing exchange-traded fund that you own and move it into a tax-free savings account. If you've got some Satrix 40s, whatever they might be, and you want to put them into a tax-free savings account, you need to sell the Satrix 40, take the cash, move the cash into the tax-free savings account, and buy the Satrix 40. You cannot transfer across. And it didn't make sense to me, but when you drill it, and I was chatting with someone in National Treasury last week, and their response is quite simple. It's the complexity of, so if you move shares, at what price did they move? What happens if you move Satrix and it's 30,000, but whilst it's moving, the price of Satrix goes up to 31,000. So they want cash only. You could only put cash into a TFSA. Again, that is on your responsibility. Depending where you house the product, and we'll talk about that in a moment, depending where you house it, it is possible that your provider the platform will let you move an equity or an ETF in. And that's on your owners to make sure that it's only cash that is being moved into the TFSA. So here's an example which sourced from Sanlam Outrade, Gerrit Lampen. So On the surface of it, you look at 30,000 a year, you look at 500,000 a lifetime, and you think, yeah, nice lacquer, but really, what's the impact? And so there are, as always, when you're looking into the future, anytime beyond the immediate, there are a lot of if, buts, and maybes. But in this example, what they've got here, purple at the bottom is a contribution of 30,000 a year, done at 2,500 per month. And at 16 years, at 8 months, it flattens out because you've now put your 500,000 in. Your orange or yellow bit there is your return on the investment, and that blue bit at the top is the amount that you've saved on tax. They've run this for 25 years, but short version, your deposits in was about 500,000, your return was about 1 million, and the savings from tax was almost 500,000. So it's actually fairly significant. And as always, I mean, you can see in the early years, not a heck of a lot happening, but it really starts to happen towards the end. And of course, if we push that to 40 years, it would be even more significant over time. Because what's happening is that we're compounding on compounding on compounding. We're not paying the tax. So the first year, you get a dividend and you get the full rand instead of 85 cents. And you're like, yeah, oh, I got an extra 15 cents, but you invested. And the next year, you get some dividend on that little bit of extra money that you didn't have to pay the tax on. So it's that compounding effect. And it becomes immensely powerful. As I said, tons of if, buts, and maybes, and I won't delve into what they are, but obviously when Sanlam were putting this together, they had to make some assumptions. But short version is that it becomes massively powerful given that time. It's the power of compound. And you're basically compounding it into your future rather than paying it out to SARS. So they've done a rate of growth of inflation plus 4 and assumed no fees. Big if. But so inflation and a personal tax rate of 40%, but that's moot. Inflation plus 4, that's quite reasonable. So I'm comfortable with that. That's not a crazy return. And the fact that they're saying no fees doesn't stress me because, let's say fees are 1%. Well, then inflation plus 5, I still don't think is an onerous ask for a long-term investment. So what products can you put into a tax-free savings account? And in 2 slides, I'll come to what you can't put, because that's maybe the list you want to see more, but this is the more important one. Collective investment schemes, which are exchange-traded funds and unit trusts. They can be added in to the scheme. Not exchange-traded notes and not exchange-traded funds that cover commodities. My next slide will show you the list of exchange-traded funds that can go in. But you cannot, for example, put new gold or platinum or any of those in, even though they are an ETF. Exchange traded fund, quick touch on. We understand, I'm pretty sure, what unit trusts are. Asset managers such as Allan Gray, Coronation, Momentum, many of them in South Africa, take investors' money, pool it, invest it, trying to beat the market. Exchange traded funds say, no, that looks like hard work. Why don't we just go buy the market? So in the top 40 ETF, they go and buy the 40 shares that are in that index. Put those 40 shares in a basket, sell you the basket. Nice and simple. So that's essentially what we're looking at. And so they're not looking to beat the market. They are looking to give you market performance. Point being is, market performance is a wonderful thing. Over the long term, when I talk long term, I'm talking decades. Over the long term, your best performing asset class is the equity market. I've got data 1960 to date, and if I take any 20-year period, the best performing asset class has been the stock market. So my view is broadly, if I'm buying that asset class and I'm getting, just buy the market, and that's what we do with exchange traded funds. Structured products, we're starting to see some structured products arrive already. These will come predominantly from the long-term insurers, and they will be in a variety of different ways and means and complexities and products within them. But certainly, and there are requirements for those structured products. Obviously, the long-term insurers will make sure that their products meet those requirements, and you'll then be able to buy those in tax-free savings accounts as well. You can put cash in, and we're already seeing some of the institutions offering cash tax-free savings accounts. That doesn't massively, in fact, I'll be perfectly honest, that bores me to tears. Cash is like boring. I mean, what are you going to do? You're getting currently 5%. So whoop, the bank does you a deal and gives you 6%. Okay, so you're ahead of inflation by much, and you're going nowhere. Yeah, we want to create wealth. Cash is really, go put the cash in the bank and pay the tax on the interest. So we are seeing some cash coming in, but to me, that's not the purpose of them. It's legal. It's within the ambit, and the product will be offered, but that doesn't thrill me in the least. The retail savings bonds, as offered by the National Treasury. So we've got the South African government retail savings bonds, which the post office sells, and some other retailers. Typically, your lock-ins are 1, 3, or 5 years. You can get inflation linked and just a normal bond price linked. They're nice. I mean, the best part about a retail savings bond is that zero fees, and I suppose we can say that they're risk-free, because in truth, if the South African government defaults on debt to its own citizens, we have bigger problems. We are probably queuing to get into Zimbabwe. No, we've got real problems if our government is defaulting on our debt. So yeah, the retail savings bonds are there, a very low risk and ergo a very low return. Better than cash, but only just better than cash. And then certain endowment policies, again, offered by the long-term insurers. I am not a fan of endowment policies in the least. They typically seem to be designed to make somebody else money rather than me, but nonetheless, there will be some endowment policies offered in that space as well. There is the list of the 38 exchange-traded funds that are available to be purchased within a tax-free savings account. And I'll come to practicalities of how in a moment. So up at the top there, you've got your internationals, which are your 5 DBX funds. You've got your 2 properties. There's a third property in your equal weighted, along with your BBET 40, which is your equal weighted top 40. You've got your JC index ones, your RMBs, your top 40s, Indies, Finnies, Resis, and SWIX. From a couple of different issuers, you'll see that there are 3 top 40 funds. You've got your debt cash, which is your NF Govy, your NF ILBO, your RMB. So those are your bond-linked ones. Your RAFI, Research Affiliate Fundamental Indexation. So they take the same 40 shares from the top 40, but they weight them according to 5 fundamental pieces of data: cash flow, increase in profitability, dividends, and 2 others that escape my mind right now. We've got, someone said them? Price to book is one. Number 5? Surely that's too random. Yeah. So, if you go Google RAFI, you'll find it. There are a couple from ABSA, and then there are a couple from Satrix as well. And then what I call the bespoke ones, the Be Green, which is a Nedbank product, which is companies that have a green rating above a certain level can be included. The Momentum one from ABSA, the Sharia compliant fund from ABSA, and the Low Volatility Tracker from Grindrod. The 2 dividends, Dividend Plus from Satrix, and the S&P SA Dividend Aristocrats also from Grindrod, and then your 2 balanced. And what I mean by balanced is these are products coming out of ABSA, and they're actually a basket. So what they're doing is they've got a blend of a bit of cash, a bit of equity, and a bit of bond. You've got the growth one, which is slightly higher risk, and then you've got the protect one, lower risk, in other words, less equity, more debt instruments and the like. What is not there are exchange-traded notes, and what is not there is exchange-traded funds issued over commodities. So new gold, new plat, etc. is not there. Like there's no SBAEI, Standard Bank Africa Equity Index, because that is an exchange-traded note. But that said, with those 38 ETFs, you can do almost anything. You can build yourself a nice, diverse portfolio. By diverse, I mean geographically diverse. I mean industry diverse, and I mean currency diverse, and beyond that, product diverse. So you can go and have your lower risk cash and bonds. You can go and have your international exposure. You can have your property exposure. You can have your equity, local and foreign equity exposure. You can take that portfolio that you've self-constructed, and you can significantly reduce the risk profile by upweighting bonds and sort of those sort of lower risk, high yield products, and downweighting your equity products. So it really is, with that range of 38 ETFs, you can do as complex and as diverse, and you can run it through sharp ratios and get portfolios that will meet the vast majority of those requirements. So although it's only 38, and I'll touch on it in a moment, I have bought 2, and there's a third one on my list that I will buy in the next tax year starting March 2016. But when I look at that, to me, everything I need sits right there. Would I like to add my Capitex in there? Oh, yeah, of course. But no equities. So can't do it. I'm comfortable with that there. Pause a sec. Any questions on that list there?
They all charge fees.
They all charge fees in 2 places. They have internal fees, total expense ratios, the fee of running the fund. Well, so those TERs are ranging from 0.2% in some cases up to 0.84% for the DBX ones. First fee, second fee, transaction fee, and I'll touch on that in a moment. Third fee, admin/platform fee. So there's always fees. This might be a free presentation, but beyond this, there are no free lunches. And this really is free. The gentleman at the door is not going to knock you over for $10 on your way out. It is the PowerPoint Paul will have it. I will have it. It's on if you go to blog.justonelap.com. If you drop me a mail, Simon@justonelap, I will send it to you. Yeah. So what we're seeing, and let's pause a moment. What we're seeing is the service providers being a little bit slow on the uptake. And what I mean by that is today's the 26th of March. This has been alive for 26 days, and there are providers who are not yet providing. And I'm like, come on, guys, like what's taking, I did this presentation in Durban, was it a week ago, 2 weeks ago? And at that point, I hadn't been able to source this list. In fact, that's not true. I had 3 lists, and they were all different. I didn't know which one was accurate. It was about Monday of this week, I think, when I actually got confirmation that is the real McCoy. So what we're seeing is a little bit of a slowness on the uptake. In short answer, as a provider who's offering you the facility, you should be able to say, well, what are the applicable product? And they will be able to provide that list. In the meantime, drop me a mail, go to the website, it is available. Here's what you can't buy. No shares at all, 0. No Capitex, no nothing. No shares in your tax-free savings account. Obviously, we get shares because those have all got shares in them. What I mean is no individual shares. So you cannot go and put your own bespoke portfolio that you've carefully crafted and put together to create significant wealth over time. You cannot put that into your tax-free savings account. The shares have to come in via collective investment schemes, ETFs and the like, structured products, etc. So no individual shares allowed. No ETNs, no REITs, real estate investment trusts. Again, they do sit up there in the property equal weight and in the 2 SAPI property ones. But there was, and the reason I've put that there is there was talk initially that you were able to buy REITs within these funds. That is not the case. They are classed as individual shares, although they're retail estate investment trusts, investment trusts. I get that. You cannot put a REIT directly in. You'd have to buy a exchange-traded fund of property. No policies. In other words, if you've got retirement annuities, endowment policies, or anything like that, they cannot be transferred in, and no derivatives. With one exception, the structured products can use derivative instruments to reduce downside risk. What is critically important, and this is part of the document from SARS, and how SARS will measure this, I'm not sure, but SARS essentially say it's allowed to provide downside protection, but it's not allowed to provide upside enhancement. In other words, what they're really talking about is put options. So if the product which is issued over falls, the put option rises and it gives you some offset on that downside. It doesn't enhance the upside. In fact, it slightly detracts from the upside because the put option costs money. So they've had to purchase the put option and they couldn't go and buy all of the other assets. So for me and you as individuals, no derivatives. There will be some within the structured products. I haven't yet seen any sort of really innovative or wildly excited structured products at all. In fact, I think I've seen one structured product. It was deadly boring. It just held cash and some bonds, and then, as I said, the cash products, and well, cash really is boring. I mean, cash is lovely, but not for investing. So now we want to take money out. We've hoarded a whole lot of money in. We're doing lacquer, we're rich, but now we've got a big date, or we want to buy a house or something like that. We want to take some money out of our tax-free savings account. The good news is you can. The bad news is when it's out, it is out. It cannot go back in. So what I mean by that is you can withdraw. There's no limit. So you go and tomorrow morning, first thing you do is open a tax-free savings account and you drop your 30,000 in. And in a month's time, it's grown to 31,000 and you think, woohoo. So you draw the money out and you go and have a wild evening in the streets of Cape Town. That 30,000 is gone and cannot be re-added. In other words, you've hit your limit for this year. But more importantly, it is deducted from your lifetime limit and cannot be put in. So your lifetime limit is 500,000. You deposit 30,000 in, your lifetime limit is now 470,000. You've got the 30 year in, you've got 470 to go. You take that 30 out. your lifetime limit remains 470. In other words, money that is withdrawn cannot go back in. I get why they're doing it. Whether I agree or not, frankly, SARS doesn't really care. But it is critically important. What we're therefore saying is that in the ideal world, we want to put money into these TFSAs that we do not need for the next 17 years. The truth of the matter is your ability to see 17 years into the future is exactly the same as mine. 0. So yes, things will happen. You know, life is a curveball most of the time. So if that curveball comes along and you need to get some money out, you can. You just can't put it back in. You can take your profit. But you still can't put back in. Yeah. Correct, Amanda. So money out doesn't go back in at all. So it cannot be added with it. What you can do is you can sell within a TFSA. So you went and bought the FINI ETF, Satrix FINI. Because you know what, banks are rocking, and that's how you get your Capitec exposure, because it's in the FINI 15. Well, at this rate, it's actually going to the top 40, but what the heck. And banks are rocking and you're loving it. And then you have an epiphany, banks are going to do terrible, so you sell your Satrix FINI and you go buy Satrix Resi. Satrix Resi is rocking. That's not a withdrawal. And you can transact within these accounts. You absolutely can. And some of you folks will know I do the lazy trading system on a weekly chart where I trade indices, but I trade the ETFs. And I'm going to trade them in here. Absolutely. Not initially, because in the first year at 30,000, the numbers are just not viable. It's just not a viable proposition. But once I've got, in a couple of years when my pool of cash is large enough, I'm going to move my lazy ETF trading system into my TFSA, because that system is generating around 34% per year, and then the taxman comes along and takes their slice, and it's not so attractive. If I can do 34% a year tax-free, man, that becomes a party. So who can provide them? Well, banks, of course, government always, brokers as in stock brokers, I'll touch on that in a second, the long-term insurers, you understand who they are. They're going to predominantly do the endowment-related policies, and they will obviously do the structured products as well. Your government is good. The only thing the government will be doing is the government retail savings bonds. Banks so far have only done cash tax-free savings accounts. As I said, completely boring. Your investment platforms, your collective investment scheme managers will be able to offer this as well. So, and as I say, at this point in time, I mean, pretty much if you've bought an ETF anywhere, that ETF provider will at some point in the very near future, if not yet already, enable you to have a tax-free savings account. What's happening, as I said, is that they're just being a little slow on the uptake. There were, well, as I know, there was one that was ready on the 1st of March. There are a couple of others who have come to the party subsequent to that. And certainly, I mean, as far as I know, all of the stockbrokers are going to be doing it. Some of them will be doing slightly different products in different ways and methodologies, ditto with the banks. But if we reconvene in a year, we could pretty much say probably in a year's time, everybody will have the offerings. They just haven't got them together yet. So that process is taking time. The one that obviously attracts me most is the brokers. We'll delve on that. We can go into specifics around that when we come to the Q&A part. But that's where we're going to find the space where we can go and buy the ETF that we want. What we are seeing is some platforms saying, well, we will sell you a basket of ETFs. And for a lot of people, that's great. But I think the people in the room here this evening, we're probably a little smarter than a basket. We don't need you to build our 4 or 5 ETFs. We're going to say, no, we want that one, that one, that one. Or maybe we just want that one, as the case may be. And I'll touch in a moment on which ones I've particularly looked at. So we are seeing some baskets of those coming through at this point. But to me, what the exciting point is, it's via the brokers. I on day one, on 2nd of March, 8:30 in the morning, logged onto my broker account, opened a TFSA account. Process happened overnight. Next morning, it's opened, moved my 30,000 Rand in, bought myself 2 ETFs. That was all done by sort of 10:30 on the Tuesday morning. And then in a year's time, I'll come back and move another 30 and do it again. So fees, because aside from this evening's presentation, there really aren't very few free lunches. So there will be a brokerage fee. What we are seeing so far is that everyone has offered a discount brokerage fee. So they've dropped their rate. So if your stockbroker typically charges 95 Rand or 0.6%, they'll say, look, in a TFSA, we will charge a lower fee. And if you don't like the fee, shop around, as always. Statutory fees. So there's no STT. But for example, VAT on brokerage, and I know VAT's a tax, I get it. That maybe is the small print part. But most important is straight. Straight is your secured transfer, R11.58. Straight is given a 70% discount, so you're paying a minute amount in terms of the straight. There's no STT, and we really are seeing very, very cheap. I mean, my 2 transactions per each of them at 15,000 a transaction, and now I can't remember. I think it was 0.4% all inclusive. Everything, 0.4. That's nice and cheap. That's nice and cheap. Of course, there may be admin fees. The platform that you are on will potentially charge admin fees, much as your stockbroker charges you a monthly or quarterly fee, as much as your platform that you're using is charging you a fee. So they may elect to charge fees. Again, if those fees look onerous, real simple, shop around. And there can be advisor fees. Now, I don't think we're going to see a lot of advisors selling these products. Simple reason, there's just not enough commission in them for them. Now, how much money can you really make on a 30,000 Rand per year transaction? But nonetheless, if you are going through an intermediary, through a financial advisor, they are allowed to charge a fee as well. And then, of course, some platform fees, which in many cases will be your admin fees. It'll broadly be the same in that space there. So some watch outs. Costs. I mean, always watch out for the costs. Yeah, that picture I showed you earlier about how wonderful and everything that how much, you know, 500,000 in contributions, 1 million in returns, and 500,000 in tax saved. All very nice, but that was ex fees. To your question, so fees are always. We understand the power of compounding interest. Fees are exactly the other side of the coin. They are being compounded out of your future. And it can massively hurt. You did my presentation on Monday evening, I show you that horrible chart of what a difference of just 2% a year can make in terms of fees to what your ultimate value is at the end of a 20-year period. So there are fees. Watch out for withdrawals. If you have to, you have to. You know, but if it's a case of, you know, I don't know, your favorite wine estate's got a special on their wine, don't sell your tax-free savings account. You know, maybe pass up the special on wine. Maybe, I don't know, maybe pawn the dog or something like that. Don't exit. But if there is a crisis and you need the cash, it is available. You can withdraw. That's not a problem at all. So it is easily available in that sense. There, watch out for those limits. 30,000 a year, 500,000 a lifetime. Someone's going to make a mistake on that. SARS is going to penalize you heavily. And the onus is on you. It is not up to the provider. It is not up to the platform. It is not up to the product. It is up to the individual to make sure you don't exceed those limits. So what to buy? For me, I bought BBET40 and DBXWD. So BBET40, and I just did 15,000 each. BBET40 is the top 40 index. It is the 40 shares that make up the top 40 index, but equal weighted, 2.5% each. I prefer the equal weighting. You know, yes, at the moment, on the latest numbers, NASPAS and SAB make up 22% of the top 40. And at this point in time, that's a great thing because those stocks are doing good. But they're not always going to be the best 2 stocks. And I don't know when they will stop being the best 2 stocks. But at some point in my lifetime, assuming I make it home to Josie tomorrow, at some point in my lifetime, they will stop being the best 2 stocks. And now you've suddenly got the massive weight in your product, and they're going to start drift down. Just a quick side point: there is another rule where no equity, no individual stock can be more than 10% within the tax-free savings account. That is not applicable if you are buying an exchange traded fund. It is for the structured product and the endowment providers. So I buy the BBET40 equal weight. Every one of those 40 shares is 2.5%, administered by Nedbank, and Grindrod Bank have purchased it and will take it over in the next couple of months. I then buy DBXWD, which is the MCSI Worldwide Index. That is currently around 57% US, around 11% each to Japan, the European Union, and the UK respectively, and then the rest is the other bits and pieces around. It is a US dollar denominated index, so they take your rands, they turn it into dollars, so I get currency hedge and I get global exposure. So what you do, so it's a great question. So an American company, so dividend tax in America is 30%, okay? As an individual, if you go and invest in America and pay tax in South Africa, you can apply for what is called relief at source. You pay a fee and and then you only get taxed at 15%. At this point in time. So the DBXU, the Deutsche Bank administrators apply for relief, which means they get taxed 15%. You're saying, is that being relieved? Short answer, don't know. Long answer, I imagine not. Because American governments want some pound of flesh too. They've got habits. No. So they knock it down to 15%. And what we see in America is a lowish dividend payment because of that high rate. So what the big rage in America is share buybacks. Because that's a more efficient way of returning, in inverted commas, the profit to shareholders than a dividend, which attracts a 30% dividend tax. So an average portfolio manager would not be applicable. Of course, there are portfolio managers out there who are Category 2 licenses, and then, of course, they can set up and make that happen indeed. And then the question I was asked on Twitter was, what about the PropTrax 10, PTX 10? And short answer is I like it, and short answer it would be added in. But at this point, I think property is expensive. In truth, I said that 15, 18 months ago, and so far I've just been looking stupid. At some point, I will stop looking stupid, and I will say I told you so. Until then, I just pretend I never sold my property holdings 18 months ago. So, but that I'll worry about. So probably what I would do next year is take my 30,000 and put 10, 10, 10. And over time, I will build it. And understand, I'm mid-40s. I've got time on my side, etc. I will slowly, over time, build this to slightly more diverse. So next year, I'll add some property to it, and maybe maybe at some point, some inflation-linked, or I don't know if I really would want to add, but that sort of thing. I'm in no rush to quickly make this a low-risk portfolio. At my risk profile, I quite am able to embrace the risk. So I'm comfortable with it at this point in time. So let's talk on the children issue. A couple of issues. Firstly, under the age of 7, they are an infant, nothing you can do. When they hit 7, they become a minor. As a minor, you can open a tax-free savings account for them. You need a birth certificate from the child, and you need FICA from the guardian, or the parent, as the case may be. But then, so you only open it at 7, but you're 100% right. Then you've hit their limit at 23. But maybe at 18, they draw it out for varsity. That's very nice, but you've now, stolen's the wrong word, but you get what we're saying, is you've taken their capacity there. So my first thought... But that's just the problem. I buy for my niece and nephew, but I'm giving them that money when they're 50. No, because think about it, 20, right? 20, what are they going to do? Sex, drugs, rock and roll, motorcycles, no chance. 30 years old, no chance. Someone's going to marry them for their money. 40, midlife crisis, another motorcycle, no chance. They get it when they're 50. But I made a rookie error. I told them about it. I shouldn't have ever told them. But here's the question that I'm currently... So I have opened a TFSA for my nephew because he turned 7 last Monday. I haven't yet put money in because of your issue there. Do I want to use up his TFSA? Don't know. I don't know the answer. It's a great question. I'm probably not going to. I'm probably going to say to him, you know what, this money which you get really when you're 50, I'm quite dead serious about that. And he will hate me, but I'll be dead, so it's not my problem. I'm probably not going to. And then, so a last point on the minors, and this was important because it took forever and a day to finally get the answer, is that the money can only be paid out into a bank account in that minor's name. Which is easy. I mean, you can open a bank account for a minor, no problem at all. But the point is that you cannot transfer it into your bank account and you buy the motorcycle. It's got to go into a bank account in the minor's name, if and when. So I'm with you, ma'am. I'm on that dilemma. And I'm probably not going to use it for my niece and nephew. I will let them do it at their own point. And this was also a grey area. I'll get to the question there in a second. The short answer is that there's no limit to how many accounts that you can have. And the long answer is it's your onus to make sure that you don't exceed those limits. And there could be the complexity. So I open one for the kid. The father opens one for a kid. You don't tell him. And I don't tell him because I'm keeping it a secret from the whole family because I don't trust any of them. We all throw money into it, and one day... And he tax defaults, the kid. Well, you see, no, but I'll make it the father's problem, not mine. But yes, and ultimately the tax liability is to the parent or the guardian. So it would be my sister or... By the time he catches it, But the penalty, SARS will flag it on an annual basis. So it gets submitted into a tax return. I buy ETFs for my sister. That gets submitted in her annual tax return at this point. And now that he is 7, so what I did when he turned 7, 2 weeks ago, literally, I opened a TFSA account. And then I stopped and paused for your question. What I'm going to probably do is I'll open him a vanilla brokerage account and move it into that vanilla brokerage account. So the requirement is, from a provider perspective, be that a broker or whatever the platform is that they need to issue ITB3s and ITB-Cs. So that Cs and Bs, and those are then issued, and that is a requirement from that is a legal requirement. One is basically a profit and loss statement. One is basically how much interest that you have earned, and this is for tax. There will now be an additional, essentially on there, which will say this is ticked as a TFSA account. And if you submit that documentation to SARS and they see that you've put 45,000 in instead of 30, that's how they catch you.
So does your nephew at 7 now become a taxpayer?
No, you have
to register, otherwise how do you record the 30,000?
So that was the big, massive debate that we have. Technically, my sister is the liable for it, and I thought I couldn't do it because he doesn't have a tax number. But SARS has said, no, the individual does not need to have a tax number at all. They will reference it to ID number. It's like, well, cool, my nephew doesn't have an ID number either, but SARS is saying no, because it is in his name, and he's been featured, and his name is Zakes Willen, and my sister is Samantha Willen. They're separate, so SARS will view them as that point at separate. Could it be an admin nightmare come tax? It could. I mean, time will tell. I mean, we are 26 days into this process.
So somebody with 5 kids, how is SARS going to figure out?
Well, they each have well, I was going to say they each have a different name. I mean, hopefully they each, unless it's a crazy household. Ma'am. Yes. So I've seen a prototype from my stockbroker, and basically on it, there is a thing that says tax-free savings account, and there is a tick or there is a cross. No, there's some admin nightmares here. I mean, this is early days, guys. We're 26 days into the process, but there might be some admin challenges down the line, ma'am. So in the case of my nephew, it's a birth certificate which proves that he is Zakes Willen, but the issue is the ID number and the FICA documentation is my sister. So what we've essentially got for SARS's purposes there, one ID number, 2 names. But you are right, and a lot of stuff, and I don't know if it's happened yet, but where brokers are submitting directly. For example, I mean, when last did anyone get an IRP5? We don't. It just goes direct. And that's going to be happening more and more and more. The document, basically your tax return will just be a case of SARS will say, send us X. And you can either send it or object. No longer, even the e-filing is going to fall away. So it's going to be SARS is going to say, you know what, we know everything about you. Just almost send us money. So quick recap, 30,000 a year, 500,000. And I know I've now said that 5 times. So I won't say it 6, maybe. But that is critical. And yes, it will increase. I imagine in his budget speech for February next year, Minister Nene will stand up the road there in Parliament and push it from 30 to 32 and push it from 500 to 510, whatever the case may be. It will increase. It'll increase slowly. I mean, maybe at the rate of inflation. I mean, don't expect it to storm along, but it will slowly increase. Individuals only. No trusts, no partnerships, no CCs, no PTYs, no nothings. Individuals only. Yes, that individual, obviously within the appointed products, which are exchange-traded funds, because as the next line says, no shares. But yes, it can be a full managed by you, the individual account. Yes. And to my mind, I mean, that, as I said, for a lot of people in the streets of Cape Town, maybe less so, but I think for people in this room, we probably know, we certainly know a heck lot more than the average person, just by the proxy that you're here this evening and you know what JSE stands for. You do, hey? Johannesburg Securities Exchange, anyone? No? Okay. But we can say, I want that ETF, I want that ETF, not that one. Hey, I own this one, but now I'm going to sell it. So it's exchange-traded funds. That's what we focus on. To my mind, it's those. No tax, 0 tax, except when you're dead. Bigger problems. And to my mind, I mean, so I said, and Paul was wrong, you couldn't do it in the next hour because I was speaking, but you can now do it in the next hour if you rush home in time. I expected, it's been around for a while. There's been talks and meetings, and this has been progressing, and conversations with the stock exchange and treasury and all of this. And I expected a product that I would have a lot of holes to poke at it. And in truth, I've got 2, and none of them are very massive. One is I would like to do shares in it. I understand why SARS does not want you to allow shares, because you might have taken your 30,000 and gone and bought African Bank. and your 30,000 is now 0. So SARS is in a sense, and I get that they're being a little nanny-ish, but you know what the heck, I can actually live with that. And I also object to the 30,000 per year and 500,000 lifetime. Two things: A, it'll increase, and B, it's a 1% problem. The vast majority of South Africans are not saving 30,000 a year. And SARS is aiming at a broad mass product. I'll brief you in a moment, sir. So to my mind, is it a should you or shouldn't you? You absolutely should. I mean, what I did was, when I say I opened one for me, I opened one for, I managed my sister's account, and I opened for everyone. Went and bought them. Now, in the case of my sister, she doesn't have 30,000 Rand, so I went and sold some of her ETFs that she holds in her vanilla account, transferred the 30,000 Rand. She's got a CGT hit on that sale. But remember that you've got your first 30,000 of CGT per year is tax-free. And I'm only selling 30,000 worth. So I think her CGT was 5,000. So there's no tax there. So what there is a transaction on the sale, a transaction on the purchase. So there's some transaction fee. And I would do that every year. On the last day of February, I will sell her 30,000 of ETFs. And on the first day of March, I will buy her 30,000 of ETFs until she either can afford the 2.5 a month or hits the 500,000 limit. So really, I see no drawbacks. There's some small limitations, but short answer, I think it's an absolutely brilliant product. So you had a question. I thought there would be. So I thought that SARS might say, if you're 65 or older or whatever the age SARS would elect to.
Because you don't have a 16-year window.
Well, but you know what SARS is telling you? So SARS is telling you that, so if you are 60 today, you've got a 50% chance of making it to 90. The first person to live to 150 is already alive. Look, it's my mother-in-law, so don't worry about it. It's, but I thought there would be a concession. So what I thought SARS would say is that at a limit, 65, 75, whatever, at a certain age point, your annual limit falls away and perhaps you can just rush it up, etc. They didn't. There's no direct, no one would tell me why. I know there was discussions around it, but then it didn't go anywhere. What it might be, they might be concerned around abuse, that you quickly drop your 500,000 in, and the person who benefits from it might not be you, but the heirs of your estate. Will they change it in time? I think we will see some small changes. I think broadly as a product, it's going to stay the same. I don't think we're ever going to see shares in it. I think it's pretty much going to stay as it is. I think we will see the limits increase. There might be some tweaks around the processes. I'll be with you in a sec. Just because there might be some issues coming up that we'll hit into, and SARS will discover them. They may do a tax-free savers for what's the polite term again? 60 pluses. Well, you're pushing it. SARS is going to say nonsense. 70 pluses. So
going back to the products, do you not want to look for high dividend yield?
So you know what? A lot of folks, and let's go back to that product page. I've had a lot of folks who are saying, well, they're going to go for the high dividend products. Firstly, so the Satrix Divi is a modesty one. The S&P SA Dividend Aristocrats is an aura. Your highest Divi one's probably one of these property ones. The point is that an asset class gives a return, and that return is broadly made up of two things. It's the return of the asset and then the income derived from the asset. And if you look at property, I mean, at the moment, in the last 10 years, property's been the out-and-out winner. It's given annualized, I think, 19.4. Equity's given 18.1. But over the longer term, equity wins, but it's that total package. The question is that if you're looking for cash extraction, not to take and spend, but to take and buy something else, then yes. I ran it around in my head, and I ran some calcs and the like, and the increased dividend yield is not increased. I see why we're doing it. The 15% falls away. So maybe, here's where I settled on. Let's say I've got some high dividend stock ETFs in my portfolio already. Would I transfer those first? Yes. Yes, because here let's say I'm earning 30,000 a year in dividends and I'm paying 15% to SARS. I switch that to there, boom, I'm saving myself 4,500. So my view was, if I've got a high dividend yield product already that I want to keep, I will sell and move that across in. I don't. I have Satrix Divi, which is a 3% dividend yield. It's nice, but it's not that high. So that to me was that if I've got something already that's costing me a lot in terms of tax. It depends who you're transacting. So for me, a 1,000 Rand, no, I lie. For me, a 300 Rand transaction is going to cost me 1.1%. So what's that? I mean, it's an edge. So and it's perhaps unique to my provider, but my provider is basically making it viable for me to actually do incredibly small transactions and to invest. So if I got $900 of dividends, so what I will probably do on a quarterly basis is, because I want to, is take my dividends, whatever it might be, a couple of $100. It's going to cost me a little, but it's not going to cost me the $100 that it would cost in a vanilla brokerage account because of the fee structures. It's going to depend on how well that portfolio is doing relative to the stockbrokers. Because what you can do is, if you've got a portfolio of individual shares, a broker can go and pick a couple of really quality companies that are paying really, really good dividends. And could we replicate that dividend yield of your portfolio in an exchange traded fund? Excuse me. Short answer, it's good. So then it depends. So if we look at the ETFs that are there, none of them are really, except for the property ones. Let's ignore those for a sec. If we look at like the two dividend ones, we are looking at yields there of around 3 on the one and about 3.6 on the other. None of them brilliantly spectacular. We've got the Prefx, which is preference shares, which is offering a dividend yield that's probably closer to 4.5 or 5%. But there you get no capital appreciation. So that's not particularly thrilling. So then it's the property guys. And yeah, I would imagine that a concentrated portfolio focusing on dividends, a dividend yield will beat all of those. I mean, when I first heard of these, I mean, what did I want to do? I wanted to trade Aussie futures in here, didn't I? I mean, of course, day traded, 100 trades a day. But no, you can do as many trades as you want. That's not a problem. No CGT, no nothing. Of course, there are transaction fees per transaction. But certainly you can, what we would call trade in that account, absolutely no problem at all. As long as it stays within and stays within. A last point, I'll be in a sec, sir. So another point that's important, perhaps, is that in the first year, you cannot switch providers. In other words, if you've got a product at provider A and suddenly provider B is looking more attractive in terms of costs or something, you cannot switch the provider. As of 1 March 2016, i.e. at the end of this tax year, you will be able to switch providers. So you'll be able to say, take my TFSA from broker A and move it to broker C. But you can't do that in the first year. So on the stockbroker side, we've got Standard Online Share Trading, both their share trading platform as well as their within internet banking. And you can transact in either. FNB has an offering. PSG is PSG, but they're only offering collective investment schemes, are they not? So PSG is only doing in the unit trust space. ABSA is not yet up and running. But are expected to fairly shortly. And Sanlam. AfriFocus is up, Sanlam is up. And who's the other one? Is Lachai up? Not yet. The short answer is, remember, the short answer is simply phone your broker tomorrow morning at 7:05 and say, do you have TFSA? And if they say no, cool, put the phone down. Phone at 8:05 and say, so is it ready yet? No, but what have they been doing for 26 days? So we will get there. And if they haven't, I mean, harass them. Absolutely harass them. And they will all be up. I mean, I said earlier that by this time next year, in truth, that's not true. By this time, third quarter, pretty much everyone will have their offerings. It is not I mean, look, I'm not an IT expert, but from my understanding of the process, it's like, 4 lines of code and 2 clicks.
So TFSA are not...
They do have an offering, yes. Launched on Tuesday. I have a bugbear with it, but I will first speak to Nerina Visser before I bug my bugbear. Well, Nerina's cleverer than me, so I'm going to go that bugbear very carefully. Sorry? Yeah, so they launched that Tuesday evening. Yeah. But yeah, I will chat with Nerina on my bugbear and hope that she doesn't. So it's just it's it's an act of parliament where you're an infant until you're 7, then you're a minor until you're 18. Ladies and gents, we'll park it there. If you've got more questions, come and harass me. But for now, so I mean, I go back to my very, very last slide, which I'll get to in half a second. And I was going to put a Nike logo there, but I thought let's not. Nike will probably come and sue us. Just do it. Just go open a TFSA. If your broker doesn't offer it, harass them. In your example, perhaps not. Maybe if you've got some high dividend yields in there, you want to move those into the process. But in essence, what did Minister Nene do? And he's a great man. We've had brilliant finance ministers for 20 years. And what does he do? Minister Nene stands up and basically takes money from us here and takes money from us there and then takes money. You wait until you see the petrol price increase next month. And here he actually gave us some money. But only if we take it. We've now got to actually go and action it. It's not like money he sends us in the post. We've actually got to open the TFSA, hoist stuff in it there. And in the first year, we're going to make the princely sum of close to nothing. But when you come back in 17 years' time, I won't be here. I'll be hopefully by then surfing in Durban. But when someone comes back here in 17 years' time, yeah, man, it's free money and it's going to add up. It's going to be significant in time. Ladies and gents, we'll leave it there. If you want the presentation, Paul will have it. You can mail me, simon@justonelap.com. It's on the website. Go and open one. Thank you very, very much for your time this evening.